One of the many good things that came out of the pandemic was time to focus on self and on personal lives. Personal finance was a huge part of this, and many turned to learning about the markets and investments and how they could make their money work for them. More and more people got interested in what will be covered through our next session, investing in mutual funds. I would now like to welcome Mr. Nilabh Sanyal, the COO of Kuvera.in, an IIM alumni. Nilabh is a professional with ample experience across financial service disciplines, including investment banking, treasury, wholesale, and private banking, and engaged in developing and leveraging technology to redefine the delivery of personal financial products and services. Welcome, Nilabh. It's a pleasure having you at SkillsFactor.
Hi, Mamta. Thanks a lot for the kind words.
Go ahead. The session is all yours.
All right, thanks. I'll just take a moment to share my screen. Let me know if you guys can see.
Yes, we can. A big hi.
So a big hi to everybody, and a very happy Republic Day to all of you who have joined in today, and hopefully are enjoying your session so far. So this is a slightly different type of a session. Some of us are in the in the beginning phases of our career. Some of us have been working for some time. Here we talk about self primarily and try to understand and try to bring some focus on financial wellness. I just want to sort of preface this a little bit. This session is not going to be about how do I get more income. This session is going to be about how do we create more wealth for ourselves. And the fundamental difference between income and wealth is long-term. Income is like a P&L, wealth is like your balance sheet. That's one way to think about it. But enough talking, let me walk you through. By way of a quick background, like Mamta kindly introduced me, we run this platform by the name of Kuvera, and we are present in various segments of personal finance, including mutual funds. We also offer domestic equities, international equities, fixed deposits, etc., etc. And this is, the platform is completely focused towards individuals and how they can improve their financial wellness and improve their financial well-being and achieve their financial goals. So that's a little bit about me singing for my supper, but let's get ahead now. So what are we here for? Basically, I've just, sort of gone ahead. This was a slide in the middle of the presentation, but I've just brought it right up ahead. And basically, the idea is to share a plan to invest for your financial goals. Now, each of these terms would have, specific meaning for each of us. But let's see what could be some of the financial goals that we have. And depending on where we are in the career, where we are in our personal lives, financial goals could be very different for different people. But fundamentally, there are two factors which define your financial goals. One is by when do you want to achieve that financial goal? And the other is what is the amount that you think you will need to achieve that financial goal, right? For example, do you want to buy or upgrade your car in the next 5 years? Another example, are you saving enough every month for the things that you want? This could be the next iPhone or the next S23 Ultra that is getting launched on Feb 1st. Do you want to buy a house in the next 10 years? If you have kids, are you investing for their education? Maybe, some of us have ambitions to send our kids overseas for studies. And are you thinking about retirement? The first 10 years, probably none of us think about retirement, but the sooner you start, the better it is, because that is one way, starting early is one way to sort of increase the wealth that is available to you to enjoy. Let's get into some of the reasons why we don't invest. And again, I'm changing direction a little bit, but just this is for context. A lot of us think that while we are while we have a salary income, we don't have any money left to invest at the end of the month, because the approach that we take is uh, investment is what I will do once I have money left over from my salary. Uh, so it's not an essential, sort of approach. But think about it this way, that investment is going to help you achieve what you want beyond your needs. See, all of us are, all of us will be making uh, some salary over and above our needs, right? Some income over and above our needs. The first priority should be to think about how we can invest this and then use what is left over for our wants. The other reason is commonly, sort of understood reason is that we will start investing when we have more money. Now, this is just an example of the sooner you start, the better it is, and it doesn't matter what the amount is. It could be even 5,000 rupees a month, and just the difference of a 10-year, if you start, let's say, you after 40, you can start investing 15,000 a month versus today you can start investing 5,000 a month. This is just an illustrative number, but in 20 years, that 15,000 a month could translate to 2.3 crores, which is great. But if you had started investing 10 years earlier at 1/3 the amount, which is 5,000 a month, that amount could translate to 3.5 crores. So as you can see that this, starting early without worrying about how little you're saving or how little you are able to put aside, goes a very long way. Another, this is a slightly technical one, but the way to think about it is this is compounding. Every year, whatever return you're making, if you stay invested, you are going to earn further return on the investment. That so it will keep growing with time. So to give an example, a very simple example, let's say you are earning 10% every year. If you've invested 100 rupees, the next year you would have 110, right? And the year after that, you would have, not only would you have another 10 rupees from the 100 that you've invested, but even the 10 rupee return that you earned in the first year will earn you another 10%. So you would end up with 121, right? So this is a very simple way of understanding compounding. And those who understand compounding, they can benefit from it. And this is a saying by Albert Einstein. I'm not sure if it is by Albert Einstein, but yeah, it sort of brings it out that if you don't understand compound interest, or if you can't use it to your advantage, you would end up paying for it. The other reason is, to shy away from investing is what's wrong with just putting an FD, because that's what our parents did. It's easily available, salary account hai, I can just log into my account, put aside an FD and save a return, save towards my financial goals. Why take a risk of investing in mutual funds or equities or any other kind of financial product? So fundamentally, what we understand, or what we should understand, is that the enemy here is inflation. A movie ticket 20 years ago, or 10 years ago, or even 5 years ago, is at least 2x. 5 years ago is at least 2x of what it used to be. A movie ticket 10 years ago probably be 3x or 4x. And 20 years ago, I can't even imagine. I remember 20 years ago, we used to buy movie tickets for 15, 20 rupees. Today, the popcorn costs more than the movie ticket. So the inflation, steady state inflation is around between 5 to 7%. FD returns are very similar to that. So yes, FD is a good product to invest in if it is meant towards saving for short-term financial goals. Let's say you have to make some kind of a financial commitment in the next 1 year, 2 years, even 3 years. Then you could think about FD as one of the products in which you are investing. But aside from that, for a long-term from a long-term investment standpoint, FD may not be the best, sort of option from an investment perspective. So again, the younger you are, the better it is for you from an investment perspective, because the big tool that you have in your arsenal, like in the earlier slide, your enemy is inflation, and the big tool or the big weapon that you have in your arsenal is time. So if you start investing early, that means you have the capability to ride through far more volatility, take far more risk for the long term. And fundamentally, this slide is more to highlight what are the kind of returns that a 1 lakh rupee amount invested would have given you over 20 years. Now, again, traditionally, we would have, what would the traditional investment options? There would be probably real estate. Again, thanks to our parents, that, so and so made so much money in investing by investing in real estate, or, let's just put our money in FDs. So over a 20-year period, real estate has, probably grown by about 4x, which is great. FDs have grown better than real estate. So that, though they would, that return would amount to, that amount, 1 lakh would amount to 4.3 lakhs today. Gold is another favored investment. Any festival in the, any festival, any auspicious occasion in the house, typically we think about gold. But is it really, something where you would invest a large amount of money? And of course, each of these instruments come with their own set of risks. But for example, gold, the risk is that you may end up buying gold from someone who's not, who's giving spurious gold. Or if you buy the best quality gold, you may have to incur costs of protecting it, keeping it safe, like a locker charges or something like that, right? So which is known as the carry cost. So even on, so this is before carry cost, your 1 lakh has become 4.9 lakhs. And now look at the BSE Sensex, which is a very broad-based index comprising of 30 stocks, which is listed on 30 stocks by market capitalization, which is listed on the Bombay Stock Exchange. That 1 lakh rupee invested over 20 years would have become 10.2 lakhs, right? And, fundamentally, nothing wrong with any of these investment options. You could have a need for real estate. Let's say you want to buy real estate to stay in it, buy a property or buy an apartment to stay in it. That is completely fine. But as an investment option, real estate may not be the best, this thing to invest in, because you can take capital, you can take tax benefit on investment. You can take, you can take a loan to buy, leverage to buy real estate, but the return that real estate has generated you will not be able to justify as an investment option, especially now. Same for gold. If you need to have, consumption. So a wedding in the family is a classical example where one invests in ornaments, but they are ornaments for use. So if you're investing or you're purchasing gold to consume it, and I'm using these words very carefully when I'm saying consuming real estate, consuming flat, what does it mean? That these are assets that you're acquiring to use for your own consumption. Let's say, you're buying a 2 BHK today and you want to stay in it. And after 10 years, you may want to upgrade to a larger house. That is fine, but that is not, don't think of it as an investment option, right? Same for gold. If you're buying gold to consume it, that you have to wear it for occasions, or you're wearing, sort of accessory, as an accessory, fashion accessory, that you want to wear it and your work, or your work, sort of allows it, or your personal preference is to, consume gold, then it's fine. But don't look at it as an investment option. Sensex, you can invest in Sensex in many ways, and we'll come into, look at more details. But right now, this is more to compare and understand over a 20-year period how risk can act in your favor. Taking that additional risk uh, is very different from being rash. Third reason, we are very busy. And believe me, being busy, this is, and it is true. I don't doubt that we are busy. We have, all of us have jobs that we love. We may be, we may have hobbies which require significant amount of time commitment. We may be planning for something. We may like gaming, which is, taking up time. You're out for a movie. You're spending time with family on weekends. Spending time with friends on weekends. So there are a lot of uh, uh, there's no question. All of us are too busy. Um, but fact is that don't push this. Don't deprioritize investing for yourself. Um, think about it this way: that if you were to spend, let's say, I'm just putting a number. Let's say 1 day in a month for the next 12 months, that translates to probably, sort of 2 hours in a week. A 1 day in a month translates into 2 hours in a week, right? Maybe 1 hour a day on weekends. So Saturday, Sunday, set aside that 1 hour or 2 hours to plan. Because finally, if you are too busy to invest, you can't make, you probably won't be able to do stock market investments, because that requires a lot of time and effort in terms of understanding opportunities and making those investments. But mutual fund investing is uh, fill it, shut it, forget it, right? So you just have to plan. You have to get started, and once you do that, you have to understand where you are investing. You have to understand the asset class. You have to understand how much you have to invest, and you can probably forget it once you start your plan. Once you start an SIP, after that you can forget about it for the next 1 year. And why do I say 1 year? Because next year आपकी salary increment होगी, then there will be an additional opportunity to invest. You may get a bonus from your employer. There may be an opportunity to invest more. So this is in Gujarati. Do any of you know how to read Gujarati?
I do a little bit, I think. Bhadu, vyaj, nafo.
Okay, so what does that mean?
So bhadu is rent, vyaj is interest, and nafo is profit.
Did you see this
Perfect.
presentation?
No, I am not.
Okay. So when you think of income, salary is also an income. And I'm assuming that our conversation today, our discussion today is primarily focused on folks who are salaried. One of the main sources of income for us, for a large part of our professional lives, remains a salary income, right? What is the difference between salary income and these three methods of, these three different types of income? Could anyone take a shot at it or an attempt at it? Rent could be from buying a house and putting it on rent, or owning a shop, commercial establishment, putting it on rent, having a car and putting it on rent. Could be anything where you're renting out an asset that you own, right? Interest is self-explanatory, but interest is, let's say you're earning interest on fixed deposits. Interest is what you earn on provident fund, or any financial investment which gives you interest in the return in the form of an interest, or you're giving a loan to someone. On that also you could be earning interest. What is profit? Profit is simply when you make an investment, it increases in value, and once you sell that off, you're able to generate a return. So the selling price being greater than the buying price, that difference is the profit. So I went through the definitions also. Can anybody take a shot at what is the
So
difference between?
Soma Prasad and Vijaya say that these are passive incomes.
Fantastic. You straight away given the right terminology for it. But let me put it differently. Yes, that's true. That is the right answer also. Passive income, rent, interest, and profit are all passive incomes. But think of it this way: fundamentally, the difference is in each of these versus salary. Salary में आपको office जाना है, आपको काम करना है. You have to report to work at 9:30 every day, and whatever your office timings. You have to perform. You have to deliver. Um, this is where your money works for you. In these forms of income, you don't work for you. You don't work to generate money. Your money works to generate more money for you, right? Let's go through these examples again, and that is why this is called passive form of income. Rent is when you make an investment of your money, you pay an upfront amount to acquire an asset, and you put it on rent. After that, you're not involved, right? Probably maybe once in a year, rent आपको आता रहेगा. Maybe once in a year, you need to look for you'll get an increment also on the rent, or maybe if the tenant moves out, you will need to find another tenant. But that is all in terms of involvement. Otherwise, 365 days minus that one day on which you have to put that effort, you are free. Same for interest, right? These are passive forms of investment because once you put in the money, and if you made the right choices, of course, I'm not saying that it's easy to make those choices, but the idea of sort of bringing this in such sharp focus in such bold letters and in two languages is to try and just showcase that we should have a mental model of trying to build these three schemes of these three forms of income as soon as possible, as early on as possible in our career. The idea is that if you have 1 lakh rupees as salary, for example, and over a 10-year period, you're able to generate rent, interest, and profit put together of more than that, you've taken care of your expenses. Of course, inflation adjusted, but you've taken care of your expenses. After that, you're working for a salary not because you need the money. You're working for a salary because you like what you're doing. Your employer is giving you something exciting to do, which is suiting your requirement. So you need not be if you don't like your job, you can quit. But the whole idea is that your needs are met. Probably your wants are also met from these three streams of income, and you're not dependent on salary, or you're not dependent on paycheck. And that should be the focus. Gujarati households, this is a very sort of imbibed in all Gujarati kids right from the time that they are born, and that's why the verbiage was in Gujarati in the previous slide. Now let's come to the sort of topic at hand. What are the three reasons why we should invest? And we already covered why we don't invest, so that's out of the way. Now, why should we invest? We should invest to beat inflation, like I mentioned. And there's a question after this, so I will not repeat. But one is to beat inflation, the other is to meet our financial goals, and also to prevent us from from spending it all. Because a lot of times the tendency is how many, if you have money in your wallet, it will get spent. If you have money lying in your bank account, it will get spent. If you have unused limit on your credit card, you may be tempted to use that to buy something that you want, which is not a necessary expense, but just because you can, you will buy it. So to prevent us from spending it all. Now, I've already answered this question. The average rate of inflation for the past 10 years. And the last 10 years, the average cost of goods, whether it was, I gave the example of a movie ticket, probably most relevant for all of us. But average cost of goods have gone up 2.5 times nearly over the last 10 years, right? Uh, we touched briefly upon this previously. What is the financial goal? It is a well-defined expense in the future. Don't worry if you don't know how well you can define this goal. If you're not sure kitne time mein aap retire hoge, you can use approximate numbers. But the idea is to think, to visualize what what is it going to be like. Whether would you want to buy a house, and some of the questions that I put early on. It's those are not things sometimes which we think about in the start of our career. But when we get married, we start thinking of these things. Maybe when we have kids, we start thinking of these things. Or maybe when our parents retire and maybe they want to move in with us, then we start thinking of some of these things, where we start thinking fundamentally about wealth. And financial goal is very simply put an amount, and after how much time will you need that amount. So this is a retirement goal example, that let's say you think that after retirement you'll need a corpus of 1 crore, and the time that you have, you because you're 30 today, typically most people would retire at the age of 60. So 30 years, 1 crore. And don't think that because I gave the example of 30 years of age, that's the right time to start planning. Even if you are not working today, even if you are finishing your studies and if you get to start a job, this is something that you can start thinking about right now. Because like the previous example that I gave you, 5,000 rupees versus 10,000 rupees investment, just that difference, 1/3 the amount, the difference can be 2x of the ending portfolio value. So you can save much lesser if you start sooner. I mean, you'll need to save much lesser if you start sooner, and you can have much larger financial goals. That's the idea. And what is a financial plan? Financial plan is effectively a means to achieve a financial goal. Here we have done some math and showed you the result. But basically, if you save 4,000 per month for the next 30 years, you're likely to have an ending investment value of around 1 crore. So this is this is just to put this construct of a financial goal and a financial plan in your mind. There are a lot of complicated explanations and a lot of detailed fancy presentations or tools that are available online, which will give you which is great. They will give you detailed plans and everything. But fundamentally, this is it. You have a financial goal, you have a financial plan. It's up to you how you want to work towards it. The sooner you start, the better it is, because you can take more risk. The sooner you start, the better it is, because you can start with a smaller amount. And the sooner you start, the better it is, because you will end up creating wealth for yourself, whether it is by way of rent, whether it is by way of interest, or by way of profit. This is another example of a financial goal. Again, this is to sort of help you understand with a different, more sort of near-term example. Retirement तो 30 साल के बाद है, but गाड़ी तो अभी खरीदनी है मुझे. So you want to, let's say you want to buy a car in 5 years time, and the value of that car adjusted for inflation is 12 lakhs. You can achieve that goal by and there are various calculators available. They'll show you different amounts, but this is the idea, that my financial goal is to buy a car for about 12 lakhs in 5 years time. And my financial plan is that by investing 12,000 rupees per month for the next 5 years, I will be able to achieve that goal. Now, now that we've sort of understood what are financial goals, have you written them down, and do you track them separately? You don't have to answer these questions, but these are questions that you have to think about. And it's important to visualize these, these things, because that is what makes investment worthwhile, worth your time, because otherwise it's just money, right? It's great. You feel great that you earned you earn a higher return than others, or you made this investment and it doubled in 5 years. You bought this stock and it started running up in 3 months time, whatever, you made a huge return. But that is a very sort of it's happiness, but it's not linked to a financial goal. The idea, if you are able to visualize it, for example, if you are able to visualize that, hey, I want to be able to buy a house for my parents where they can, after retirement, where they can settle down. If you can visualize that, okay, I have now reached a point where I've saved enough that I can send my child to the best college, let's say, wherever in UK or the US. That satisfaction, or that, that comfort, or that financial security is immeasurably more valuable than making a 15% return or a 25% return, or even doubling your money in 2 years time. So this visualization is a very visualization of your financial goals is a very powerful tool, and we should all sort of think about it and try to bring it and implement it in our financial lives. This is some data that we've pulled for users. We have close to 20 lakh users now, and these are some of the top goals for folks who are between 25 to 35 years old. It's great that people are thinking about retirement. It's great that people are thinking about owning a home and educating their children. Now, just summarizing what we've discussed already: start as soon as possible, invest according to your capability. You obviously cannot borrow to invest, but you should obviously not spend everything and not save anything, and start investing because of all the reasons we discussed earlier. Risk is a tool in your arsenal. The sooner you start, the more beneficial it is to you. Risk works to your advantage. And lastly, spend time defining your financial goals. Your financial goals can change from time to time. It can, something new will come up in life very frequently. Let's say, you were planning for your child's education, and then suddenly your next child, you have twins. So now you have to plan for the education of 3 kids. Or it could be that, you find a house that is your dream house. You do not want to wait for 20 years to buy that house, or 10 years or 5 years or whatever time to buy that house. There is just some opportunity which is available to you to buy that house today. You may want to take a loan to buy that house, but visualizing it now and trying to, sort of plan for it, even though they may change, even though those numbers may change, but at least mentally, this is what you're working towards, right? Now, in terms of investment options, just a quick context here. As Kuvera, we don't offer all of these investment options, but this is an unbiased view in terms of how you should think about investing, and what are some of the parameters that you can choose to invest. So in the first 3 columns, I mean, the first column is obviously the instrument type: equity mutual fund, real estate, gold, debt mutual funds. These are various places where you can deploy your financial savings. Duration of investment is the period for which you want to in which you should think about investing in these instruments. So the way to read it is that if you're investing for more than 3 years, equity mutual funds may be a good choice. If you're investing for more than 10 years, NPS can be a good choice. PPF can be a good choice. Even gold and real estate can be good choices. But you have to think of it also from another perspective about what is liquidity. What does liquidity mean? Liquidity means how easily are you able to access that money? How easily are you able to withdraw that money? So let's say you invest all your savings into a house which is costing 2 crores, and everything you have invested in the house. So now you have nothing, and suddenly you need to, you have a need for, let's say, 10 lakhs. you're not going to be able to sell your kitchen and get that 10 lakhs and buy something, right? Uh, this is liquidity. This is the problem of liquidity. So when you're buying certain assets, some of those assets will lose value because you own them, but those are depreciating assets. That's a different thing. But liquidity is when you make an investment, how easy is it to take out money? So what would happen in such a scenario is if you need liquidity immediately and you have no option, but you have to sell real estate or sell an apartment. Uh, we all know that when we are going to buy, markets are always moving up. Real estate is becoming expensive. It will become 2x, 3x, 4x in the next 5 years, 10 years. And when you are trying to sell real estate, markets are always down. Vacancies are very high. वो रोड तो वहाँ पे आने वाला था, इंटरनेशनल एयरपोर्ट आने वाला था, बट बहुत टाइम लगेगा अभी, तो इसलिए प्राइसेस डाउन है, प्राइसेस हैव नॉट गॉन अप. So liquidity is for real estate is low. I have nothing against real estate, by the way. I'm just saying that it requires a large exposure, large amount of investment. So unless you're consuming real estate, it's best to sort of consider other investment alternatives rather than real estate. Gold, we understood. Equity versus debt mutual funds. Debt mutual funds are also a type of mutual funds, but these debt mutual funds invest in fixed income products. They are also risky, but they are typically for shorter investment horizons. If you're looking for more than 10 years, then preferably between equity and debt mutual funds, equity should be higher, debt should be lesser. NPS, public provident fund, by design, these are very long-term investment instruments. NPS is, where you put money aside into a government-run scheme, and these are invested by different fund managers, and they will generate a return and give you. Typically, these investments start becoming available from a liquidity standpoint after 15 years. PPF, PPF is one of those preferred investment tools which we have inherited, or the knowledge of which we have inherited from our parents. And this is a great investment option because it offers you multiple, tax benefits also, tax breaks and tax benefits both. So PPF remains a great option. NPS is also a great option, but these are limited by the amount of exposure that you can take in them. So every year you can invest only up to a certain amount in each of these instruments, beyond which tax benefits will not apply. So जब तक tax benefit आपको मिल रहा है, these are great options to consider for the long term. But if you are investing, if you have amount which is in excess of the the NPS and PPF tax exemption limit, then you should consider other investment options also. Fixed deposits we already discussed. If you have a medium term goal where you need a fixed amount, you don't want any volatility, you don't want any risk, you can't take any risk, then fixed deposits can be a good investment option. Now a quick background about mutual funds. So, and I know the session said mutual funds, and we are almost through 25 minutes of the session, and we are now starting to talk about mutual funds. But the whole idea is that, see, in mutual funds is just one vehicle or one method or one savings option that is available to all investors. The fundamental point is we have to switch from the mindset of not saving to saving as much as possible. We have to switch from the mindset of यार मेरा तो कोई financial goal है ही नहीं, I don't know what I'm saving for, or I don't have anything to save for, to visualizing your financial goals. It could be something as simple as retirement. If you're not married, if you don't have dependents, you could say that yeah, I don't have kids, I'm living in my parents' house, I'm going to continue to live here, I don't have the need to buy a house, I don't want to buy a car, so I have no financial goals. But retirement is a financial goal. How will you provide for yourself after you retire? What happens after a few years? You will probably think about getting married, you may have kids, right? Wealth creation is a financial goal. So mutual fund is just one of the tools that you can use to achieve your financial goals. Fundamentally, the difference or how to understand mutual funds is a large number of investors will put in their money into a mutual fund. A mutual fund is managed by, it's basically like a bucket, which is managed by a fund manager. Those funds are managed by a fund manager. Fund manager takes the decision of where to invest, depending on whether it's an equity mutual fund or a debt mutual fund. They could be investing in stocks, they could be investing in bonds, debentures, or various other financial instruments available in the financial market. Not only will they take a call of when to invest, they will also take the call or decision of when to sell. So they may decide that it's a great time for buying Adani stock. So they will invest in and they will start taking exposure to Adani stock. And then they will think that, okay, now Adani stock has run up, it may be overvalued. So it's a great, it's probably a good time to reduce exposure to Adani stock. So they will take that call without you being involved, without you being participating in that decision of whether to invest or to pull out that money. Why would somebody trust a third person with their money? Because these are trained professionals whose job is to sort of take care of your funds, generate returns from those funds, and that is how they earn their money. That is how they earn their income, that is how they earn their livelihood. So fund manager works for the mutual fund itself, and the mutual fund is it's a government regulated. It is policed by SEBI, which is the Stock Exchange Board of India, and it is a government appointed watchdog for mutual funds. So your investments fundamentally into mutual funds are safe. Of course, if the fund manager takes the right calls, you will end up making good money. If the fund manager takes a wrong call, you will end up making probably less than good money. But the intention of and the whole this construct of mutual funds is to make sure that there is a process that is getting followed, the investment fund manager is taking conscious decisions, and the fund manager is worthy of taking care of your money. So only a registered with SEBI mutual fund can exist, otherwise there cannot be a mutual fund. When they sell, of course, they will generate returns, and it is reflected in the form of an NAV. NAV is the price at which you buy or sell a mutual fund at a particular date. This is just a summary again. Mutual funds are professionally managed. They help you to diversify risk, because our capability to understand different financial instruments and how much to invest in each may be very limited. But mutual funds help us diversify that risk across different asset classes. And stock is a different asset class, bond is a different asset class, gold is a different asset class, and so on and so forth. It is regulated by SEBI, and it is safe and very transparent. Mutual fund websites have all the information about where your money is invested, what return has been generated. If you withdraw today, money will come into your account within 1 to 3 days, depending on the type of mutual fund that you've invested in. And you can see your portfolio every day. So it's really transparent. Now, how to choose the right mutual fund? So this is a this is a sort of a matrix where we've laid down what is your what is the risk involved in investing in various types of mutual funds, and what kind of returns should these investments generate, should these types of mutual funds generate. Typically, of course, कुछ कमाने के लिए कुछ खोना तो पड़ता है. So अगर if you have a higher risk appetite, if you can take more risk, or you have a investment duration which is long, then obviously your return expectation, you should be compensated for being able to take that much more risk, and that is in the form of a higher return. I won't go into explaining each of these categories, but very focused sectoral funds, for example, किसी एक for example, a fund which invests only in technology stocks is a technology, it's a sectoral equity fund, or a fund which invests only in infrastructure like airports and probably electricity utility companies. That's a sectoral equity fund. These are typically considered to be the most risky, um, because your focus is on a particular sector, which is which may behave or have higher volatility as compared to a broader market with where there are more, if one sector underperforms and another sector can perform well, and so on and so forth. So the other extreme is sectoral equity fund, and on the other side is money market liquid funds. Money market liquid funds are money market funds or liquid funds are for very short term investment horizons. If you are investing for less than 6 months, and these are typically more like FD. Here there is less volatility. The chances of losing money are much lesser as compared to the other categories of mutual funds. But this is a very broad range, and we covered the two extremes. Everything else lies in between. And depending upon our risk appetite, how much risk we want to take, what is the period that we are investing for, we can make a choice between what type of mutual funds and which type of schemes to invest our wealth in. Again, what are the factors that affect mutual fund returns? These are just examples. Higher equity, meaning higher allocation to equity of a mutual fund scheme, there is higher the return potential because it is taking more risk. Smaller market cap funds have higher return potential, which means that if you're investing in younger companies are able to grow much faster. But there are a large number of young companies, while there are few very large companies. So the fund manager's capability to make that choice is very relevant when you are investing in smaller market cap companies, smaller market capitalization companies. So just remember one thing: the higher equity, higher return potential is the word. So there is a chance that you will get a higher return. It's not necessary. It's not guaranteed, right? Okay. These are some of the important tools, important tips, I would say, to sort of don't think about how large is a mutual fund scheme. Uska assets kitna bada hai, because that does not matter. That is past information. Another very important thing: past returns do not predict future returns. And this is, in any advertisement that you see, you will always see this underlying disclaimer which says mutual fund returns are not, mutual fund performance is past performance. They're not indicative of future returns. There's a reason for saying that, because a lot of us pick winners on the basis of who's winning right now. This may not be true for an investment standpoint. So the best performing fund, a fund which has given extraordinary returns over the last 1 year, may not necessarily continue to do so in the next 1 year. So your decision to invest in a particular fund should not only be what its past return has been. Should also look at consistency. You should also think about whether it fits with your investment plan, if your investment horizon is matching with the kind of scheme that you're investing in. And lastly, this is obviously very clear: popularity has no effect. It just could be a marketing strategy that a particular fund is running a great ad. So you can't make an investment into a fund just because they have a great advertisement. The other question that we get asked from some of the folks who just started investing is, how many mutual funds are enough? Because the typical strategy would be, इस साल ये 5 funds जो हैं best performing funds में आए हैं, इनको award मिला है, so I'll invest in these funds. Next year those funds will be different from the last year, so again you will invest in another 5 funds. So as a result, over a 5-6 year period, you will end up with 30 best performing funds from the last 5 years. But that's not how it should be. You should invest according to a plan. You should select 4 or 5 funds maximum to maximum 8 funds across different categories, which gives you a broader exposure across different asset classes. Uh, Fundamentally, think about it this way: there is very limited advantage of buying multiple funds from the same category. What I mean is that आप 4 large cap funds ले लोगे, या if you buy 4 small cap funds, there's no advantage of doing that versus spending time and making the selection, getting the selection right, and choosing maybe one of the large cap, one of the small cap, or two of the small cap for that matter. And lastly, it's easier to manage, because remember, all of us are busy, right? So the more the number of funds, the more the amount of time that we will have to spend to manage, monitor, and take decisions on the portfolio. So this is more of information for you. This is a statistical proof that you don't need to have 15-20 mutual fund schemes in your portfolio. But once your broad portfolio, because remember, mutual fund itself is a diversified portfolio of stocks. So as long as you're investing in non-overlapping categories of mutual funds, maybe 5-6 mutual fund schemes are good enough for you. Now coming to systematic investment plan. Systematic investment plan, I have a number of slides on this, but remember one thing: systematic investment plan is nothing but you put aside the same sum of money every month, just like you pay rent or just like you get salary for that matter. Same way you decide that, okay, I will invest this much into mutual funds through by way of SIP. It's lighter on the wallet because once you 1,000 rupee, investing 1,000 rupee every month is much easier than investing 12,000 rupees once in a year. Also, when you're investing that 12,000 rupees, you may not be able to make the best. It may not be the best time to make that investment. Actually, no time is the best time to make that investment. The best time to make an investment is when you have the money. So, which means that every month, along with your salary, once your salary comes in, next day, 2 days later, 3 days later, 5 days later, invest whatever you have to by way of SIPs. And it allows us the advantage of rupee cost averaging. Rupee cost averaging means nothing but buying at different price points, whether the market is moving up or market is moving down. You don't need to bother, or you don't need to worry about it, because you are investing systematically across different market cycles. Again, SIP versus lump sum. SIP is one time, investing the same amount of money every month, a small amount of money. Our lump sum is the example that I took, 1,000 rupees per month versus 12,000 rupees once in a year. So here also, your money sitting idle in your account is worse than it staying invested. So you should invest when you have the surplus available. Use the monthly salary surplus for SIPs, and lump sum should be used. Lump sum method or one-time investment should be done when you have a windfall. Windfall meaning bonus or a special allowance or something like that, which is not a regular income, or which you could not have predicted in advance. Another factor about mutual funds is there are two types, or one way to classify mutual fund is how they are distributed. So you can either go through a broker or you can buy a direct plan. So when you go through a broker, it's known as a regular mutual fund. And when you're buying direct, it's known as a direct mutual fund plan. And you can increase your return when you invest in a direct mutual fund plan, because here there's no broker involved. There is no commission getting paid, which is true in the case of a regular mutual fund scheme. This is just an example. Kubera is obviously in the direct mutual fund plan. There is no commission that is payable to Kubera when you use Kubera to make an investment. There is no continuing commission. What does that mean? That 1% of your investment amount every year could be going to a broker. Investment उसने आपसे आज कराया, but every year you are ending up paying commission. Now this is a small point But this is a very relevant point to think about, that, you may say that, yeah, 1% is nothing. I can pay that 1%, right? But it's 1% every year. And it is a cost which comes to you as an investor. Um, Again, this is to highlight that how much difference that 1.5% can make over a 40-year period. If you think the delta between a regular plan investment or a direct plan investment could be as high as 81%. So 1 rupee can become or an ending portfolio value. Let's say you have a portfolio value after 40 years. If your portfolio is worth 100 rupees in case of a regular plan, it could be as much as 181 in the case of a direct plan. So do consider choosing direct plans over regular plans where possible. This we have already discussed. Now, this was all theory, but how do we put it into practice? There are a whole bunch of financial, and there's nothing after this. This is the last slide of my presentation. We can jump into questions right after this. But there are various financial tools available. There are various websites, mobile applications available now to start investing. My message simply is that don't wait, don't spend too much time in thinking that, okay, when I get time I will do this, or when I have money I will do this. Start with a small amount. With time, as you understand this asset class, as you start visualizing your financial goals, you will be on the path to much better financial security, not only for yourself but also for your loved ones. And that's it. So thank you very much for bearing with me. I've done this for now 55 minutes, but if you all have any questions, I'm happy to address those.
Well, we do have a lot of questions, but I think in the interest of time, we can answer one.
Okay.
So we have Walid Anjum who has a question. Is it a good time to invest in mutual funds?
Like I said, it is always a good time to invest. If you have money, if you have surplus available, you should definitely consider investing in mutual funds, because fundamentally, if you're investing for a 5-year period, 10-year period, 15-year period, if you're putting money aside for the long term for wealth creation, it doesn't matter if the markets have corrected a little bit or if the markets are a little bit expensive, because I'll share one statistic. If you had invested pick any investment horizon in the past 20 years, and we've done this study, if I'm remembering correctly, if you have invested for any 1-year period, people would have made money 70% of the time. If you had invested for a 3-year investment horizon, you would have made money 91% of the time. And if you've invested for 5 years, you've always made money. So there is not a 5-year investment horizon in the past 20 years where you had invested in, let's say, 2005 and 2010, you would be making money. If you had invested in 2004, in 2009, you would be making money. When 2009 was the time when the entire financial markets had collapsed. The world had collapsed around financial markets. So yeah, I mean, there are there are those events also that can happen. When COVID became more well known, as that it's going to be, what repercussion it's going to have, Indian markets also collapsed, but they recovered very quickly. And in fact, today we are higher. Today markets are much higher than where they were when the COVID situation or the pandemic broke out in India. Simple point is, if you have the money, should invest. If you have surplus, if you have regular surpluses, consider investing by way of SIP. If you have surplus which was unexpected, it's a windfall surplus, then consider investing that as by way of a lump sum.
So that definitely answers one of the other questions which was in the audience, which was SIP versus MIP. So I think that covers that as well. There's just one more question here which says, with so many mobile app options, which app is best according to you to track and monitor investments?
Well, disclaimer.
I think you're biased there a little.
Disclaimer, I am the founder and CEO of Kuvera. But with that disclaimer, I think it's the best option to invest and track your financial investments.
So can you shed some light about what Kuvera is all about, and where can they actually go and register for it?
So our website, our website is kuvera.in. You just click on sign up. It's a 5-minute process to register yourself. If you're not KYC compliant, then you will need to get KYC done. We will do it for you. We'll help you do it. If you are on the mobile application, then you can just search for Kuvera on the App Store. If it's iOS, then App Store. If it's Android, then Play Store, of course. You can download the app, and the experience across both is pretty seamless. You'll be able to set up an account and get started with investing. We have various options to including tracking your financial goals, creating your financial goals, tracking them, making investments into various mutual fund investment options offered by, various mutual fund schemes offered by various fund houses. You could also invest in fixed deposits. We have been doing this for now 7 years. We're a 7-year-old company. And yeah, what else would you like to know? We are we have roughly about 40,000 crores in assets under advisory, close to 20 lakh users, like I already mentioned. And I would love it to have more people join.
Wouldn't we all want that, in fact? That's great. So that's kuvera.in. You will actually see on the screen, it's kuvera.in, which you can visit, and you can actually use that app. It's really helpful to everybody who needs more information and would like to invest, and just earn some money. So thank you so much. This is a very insightful session, Nilabh. I know most of the people in the audience will agree that we all know managing money is, more difficult than earning it. So now having the know-how about mutual funds and investments and how to do it and when to do it and how much to go for, I hope we all will be able to manage our finances a little better than yesterday. So our audience does have some more questions, but in the interest of time, it would be great if we can email them to you, Nilabh, and if you could be kind enough to answer as many of them as you possibly can. That would be great. Sure. Thank you once again, Nilabh. You've been amazing as always. And you can exit the webinar now while we continue on with the marathon of the sessions. Have a very pleasant day.
Thank you very much.
Thank you so much.
Bye, guys. Bye, everyone.
Bye-bye.